In this tutorial, I'll be teaching you about showing you about McDonald's Corp. It's MCD is the symbol, and you can see that if you want to buy right now, you can buy it from 213.87 US dollars per stock, and you can see that the market cap is in billions, which means it's a big size firm, and which is brilliant. And dividend yield is 2.17%. The dividend yield is very low, but I just want to say something about dividend yield. Dividend yield means extra money that a firm has after paying its costs, liabilities, creditors, it still has money left. That is called dividend. That is paid to shareholders as dividend. So it means any firm that pays dividend, that means they're financially very strong, which is a positive sign. And so this is a very positive sign that they are paying dividends. It means they're very financially strong. Um, so that's brilliant. That's a good sign. Let's see, when was this founded? You can see founded 1955. Just go to Wikipedia and you'll see the box here, which is very important. And I'll just zoom in for you. Founded 1940. And that's the thing, okay? So nearly 80 years ago. I'll just copy this name from Google exactly and paste it and type in review. And I want to check in Indeed. I want to know what the employees have to say about it. I can see there are 159.4k reviews, a lot of reviews, and it's 3.5 star, which is above average. And there's so many people who have given the reviews, but still it's above average. You can just read through the reviews yourself. It's up to you to read the pros and cons. I want to see reviews in Glassdoor, which is a brilliant website as well. And there are nearly 27,000 reviews, and it's 3.4 stars, above average. You can read through the reviews yourself. It's brilliant. I want to see if it has any patents. I use normally just patents, and I will just paste the thing here and click enter. And I just want to show you. I just want to see if this is same as McDonald's. McDonald's Steel Corporation. No, it's a different thing, I think. So you need to make sure that we are not interested in inventor, because these are people who invented but they don't have rights. We are only interested in assigning your applicant. So we want to see if it has any patent. I can't see any patent, but you can just go through the list yourself. I can't see it. There's a big list. Um, so if it has patents, any company has patents, that's a positive sign. That means the company is very strong. It has a moat, and it's difficult to beat that company. And but I can't find any patent of McDonald. But you can just go through the list yourself. Maybe there is. And just go to Yahoo Finance, and I want to see the key executives and their salaries. I'll just paste in here and MCD. So make sure they're like, if I just go by the name, there are like 4 names nearly the same, but make sure you click the right symbol as well. Go to profile, and then you can see the sector, industry, full-time employees. Okay. And I just want to show you one thing. There are 4 people, 5 executives and their titles, but only 4 salaries have been shown. The last one, it says that it's not applicable. You need to find out why it's not applicable. Search on another website and see why. Because the more information we have, the better, the more transparency and the more trust we are able to build. So you need to look into that. Now I want to go to Macro Trend. It's a brilliant website for ratios. Click price ratio, then price book ratio, and paste in the symbol. Okay, and I'll explain briefly what price ratio is. Price ratio, if price book ratio, sorry, if the price book ratio is less than 1, that means stock is very cheap. It's very cheap, it's at discount, and it's a bargain, and you must buy it because it's ideal time, it's a sale. If it's 1, that means the stock is of its real price, and you're buying it for the real price, and it's not expensive, which is brilliant. If it's more than 1, that means the stock is expensive. The higher the number goes, the more expensive it gets. So let's see about McDonald's. It's 0 right now. It means it's 0 right now. Just one sec. So it's minus 22. Okay, so here it's a different thing altogether, because the book value is in minus. Okay, so I'll just show you, I'll explain you about the minus differently. If I just see about the positive one, if I see 2016, the price book ratio is 150, which means it's 150 times more expensive. If somebody bought the stock in June 2016, they paid $112 US dollars to buy something that was only 0.75, even less than a dollar. So they bought it 150 times more expensive. And if somebody bought in 2006, 6 March, they bought it nearly 2 times more expensive. They paid $23 to buy something that was $12 worth. So you need to be careful about that. And so you need to be careful about that. So right now, if I just explain you, in 2016 September, the book value is in minus, so it's even below zero. But the price, if you see, the price is the sign price book ratio is in minus because there's a minus sign in book value. So this is that there's the if you just leave the minus sign from the price book ratio and just see from the the numbers, it says it's 55 times more expensive right now. Right now in March, it's 22 times more expensive. So somebody who buys right now, they will be buying 22 times more expensive. So that's the point. So you need to be careful that if you're buying an expensive stock or a cheap stock, so that's very important. So let's look at other ratios and current ratio. In current ratio, if the ratio is less than 1, then it means stock is very risky. If the ratio is 1.5 or more than that, that means stock is very safe. So we're looking for 1.5 or more than that. Right now, it's a little bit less than 1.5, which is, I won't mind that. I would say it's fine. Let's look. No, it is less than that. Okay, so it's kind of fluctuating. It's sometimes it's up, sometimes it's down. So it's difficult to rely on it because it's like the trend is very, very fluctuating. So I'm not sure if I can consider it a safe or a risky stock. It's up to you to decide, because it should be consistent in what it is. So if it's a safe stock, it should be consistently 1.5 or more. But this is fluctuating all the time. Every month it's fluctuating. So it's very difficult to say which area it is in. Let's go to debt equity ratio. In this part, it means that if the company is mainly operating on debt or equity. Now we want to see 0.5 or less than that for it to be safe. Right now it's 6.8. So just leave out the minus sign because the equity is a minus, so it's minus, but it's 6.8, which means that the stock is very risky because the equity is in minus and the debt is 44.52. There's a lot of debt, long-term debt, and the ratio is in minus. So a ratio is in 6.8. So it's very risky stock. It's more than 0.5, and you just assume it's a plus 6.8. So it's a lot more than 0.5. It's very risky stock. Let's look at the previous trend. So it is very, very risky stock. Yeah, since data 2005 up till now, like 14 years, it's a very, very risky stock. So let's look at return on equity. We are looking for 8% or more than that. Right now it's in minus. The equity return on equity is minus. So so you need to be careful about that. And so we're looking at 8% or more than that. So it's in minus. So it's not ideal.